Basic financial theory suggests that when it comes to investments, risk is correlated to return. You can't have a reasonable payoff without taking on some uncertainty. Yet some find the risks of investing too severe for their taste. In fact, 53% of millennials don't have investments, with 6 out of 10 citing a fear of losing money as a reason. So, what do we need to know, and how can we mitigate the risks of our holdings? We'll answer these questions and more on today's Plain Bagel. The human brain is risk-averse in nature, a clear result of survival of the fittest. Our ancestors who valued security and safety oftentimes lived to tell the tale, whereas those who didn't, well, not so much. These survivors passed on their genes and likewise their preference for security over time. And while you may not give much weighting to your caveman instincts, they still influence our decision-making process to this day. For example, many people exhibit something called loss aversion, feeling much more strongly about losing money than they do about gaining the same amount. Think about it. How would you feel if you found a $20 bill on the sidewalk? Pretty great, probably. But what if instead you lost $20 that you were planning on spending? This small loss could be enough to ruin your day, and most people would gladly avoid this risk in lieu of potentially gaining money, with many people even refusing to accept slightly better odds. This creates quite the problem when it comes to investing. You see, it's hard to earn a reasonable return without taking on risk. While low-risk investments like savings accounts do exist, they typically don't offer the return we need to reach our goals, with many barely keeping up with inflation. We often need to look to higher risk investments to achieve our objectives. It can be tough to take this leap of faith, but there are strategies you can implement to mitigate your exposure. So before you hide your cash under the mattress, let's take a look at the risks of investing and how we can manage them. But let's not get ahead of ourselves. To understand risk, we should probably start by defining it. In the context of finance, risk simply means an exposure to loss, or more specifically, the chance of your investments decreasing in value. The amount of risk we have depends on the specific investments we hold, and many people use a security's volatility as a proxy for its risk. After all, price fluctuations are typically the result of investor uncertainty, so it makes sense that investments with higher volatility are likely riskier to investors. However, a better approach for defining risk is to observe it from a qualitative standpoint, understanding the types of events that could hurt your investment's value. Interest rate risk, for example, is the risk of central banks, such as the Federal Reserve or the Bank of Canada, increasing interest rates, which oftentimes increases costs for businesses. There's also credit risk, or the risk of your company defaulting on its debt. Inflation risk is the risk of inflation being more than expected, which reduces the value of your invested money. We could go on for some time listing these specific risks, but perhaps a better approach would be to cover the topic at a high level. In general, there are two types of risks faced by investments. The first type is market or systematic risk. This entails anything that will impact all companies operating in a certain country. For example, the economy entering a recession is something that would reduce overall spending, which would therefore hurt the value of companies you are invested in. The second type of risk, known as idiosyncratic or company-specific risk, instead encompasses any hazard specific to a small number of organizations. This could include a new competitor opening shop next door, a negative change to regulation within a specific industry, or a CEO being caught up in some scandal. As you would expect, every investment faces a unique set of these idiosyncratic risks. Between these two categories, systematic risk is the harder one to predict and avoid, since it impacts a larger number of companies. Idiosyncratic risk, however, can actually be reduced through diversification. By holding different companies from different geographies and sectors, we can average out the impacts of specific company issues, making our investments safer. For example, if you hold 5 car companies instead of 1, you'll be less impacted by one of the firms cheating on their emissions test. In fact, financial theory suggests that investors who diversify actually achieve better total returns and lower overall risk than investors who don't diversify. So there's a clear benefit to spreading out your holdings. But it's worth noting that diversification is far from perfect. You see, the power of diversification is strongest when your investments are uncorrelated. In other words, the performance of the investments move independently of one another. But research has found that during recessions, the correlation between investments actually increases, meaning that investments begin to move together, thereby reducing the diversification benefit of your portfolio right when it's needed the most. Even safe haven investments, such as gold, which are theoretically uncorrelated to markets, tend to move with stock returns as market volatility increases. So, while diversification is still beneficial, it can't immunize an investor from risk. Instead, the best we can do is to adjust the level of uncertainty we take on as investors to suit our unique circumstances. You see, different investors have different capacities for handling risk. This capacity is known as risk tolerance, and it consists of two parts. The first component of risk tolerance is someone's willingness to take risk. This is heavily influenced by someone's personality type, as well as their level of financial literacy. Someone who's kept up at night by a 5% drop in the markets probably has a lower willingness to take risk than someone who checks their holdings once a year. While this aspect of risk tolerance is subjective, it is still very important to consider. Managing emotions is a paramount element of investing. And if you find yourself experiencing gut-wrenching anxiety at every decline, your ability to rationally govern your holdings will be inhibited. The second part of risk tolerance is your ability to bear risk. This is more related to someone's financial situation, and it has many moving parts, including your time horizon, level of wealth, expected future income, and so on. Generally speaking, the less money, and more notably, the less time that you have as an investor, the less risk you are able to tolerate from your holdings. The reason for this is that many risks faced by the market are short-term in nature. A recession may only last a few years, a company may recover after replacing a troubled executive, but if you are constrained in how long you can wait out these risks, then you are more likely to be hit in your return. Take a look at the S&P 500, for example. You'll notice that every decline related to a financial crisis, including the 2000 tech bubble and the 2008 mortgage crisis, was fully recovered within a 10-year time frame. While that's not a guarantee that losses will always be recovered, it does show that timing is an important factor to consider when investing. Someone forced to sell their holdings at the bottom of a crash is doing so at the worst possible time. So, once you have a grasp on your willingness and ability to take on risk, you can adjust your portfolio's risk to match your tolerance. A primary way in which people do this is by altering how much money they have invested in the stock market versus other securities. Stocks are generally considered to be a higher risk investment, so a higher risk tolerance often equates to a larger percentage of your wealth held in stocks. The rest of the money is often held in bonds or cash securities, since these have more legal safety nets in place than stocks and are limited in how much their values fluctuate over time. So, if you're a young adult saving for retirement, you'll probably hold more stocks than bonds, whereas an individual living off of their savings may have no exposure to the stock market. Risk can also be adjusted through our individual holdings. Owning junk bonds instead of government bonds and investing in emerging markets instead of developed countries can both increase the risk and return potential of your portfolio. So, there are plenty of ways to adjust our investment exposure, and hopefully I've demonstrated that risk is manageable, so long as you employ a disciplined approach and match your risk level to what's reasonable given your circumstances. And if that's not enough to convince you, just remember that most risks are short-term in nature. If you're saving for retirement, it doesn't really matter if stock A went down 3% on Tuesday. You should only pay attention to the permanent issues that pose a serious threat to your holdings. So while being aware of your risk exposure is important, obsessing over the day-to-day changes can get you caught up in the mood swings of the markets. Instead, focus on the long-term performance of your holdings and diversify when possible. If you find yourself easily affected by fluctuations, it may be worthwhile to seek out an advisor to help you through the ups and downs. And most importantly, accept the fact that risk is a necessity of investing. In fact, many of the greatest investment opportunities arise during downturns. So while you may not be jumping for joy when markets are down, it's certainly a chance to buy low. And with a steady hand and disciplined approach, you'll likely find the return of investing outweighs the risks over time. And with that said, we're out of time. If you like this video, please hit the like button. And if you like what we're doing here, please subscribe. If you have any feedback or topics you'd like us to cover in future videos, leave a comment down below. For The Plain Bagel, my name is Richard Coffin. Thanks for joining me today.